Hello, everybody. My name is Alesh Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. This is my thoughts on market happenings for the week ending November 4th, 2022. Looking at the market indexes for the week, the TSX, S&P 500, Dow Jones, Nasdaq, and Russell 2000 were all down somewhat for the week. Oil was up, as was gold. Reported Friday, the Canadian job market is doing very well, creating 108,000 jobs rather than the 10,000 expected for October, which was a blowout jobs report. Now, last week's Bank of Canada 0.5% interest rate hike is looking like it should have been 0.75% to slow the economy more. The peak of the Canadian interest rates is thought to be 4.5%, and we are currently at 3.75%. Canada implemented a tax share buyback taxes by companies, a 2% tax starting in 2024. It could have been more than the 2%, and it is still more tax efficient than dividends for most people. The government said it will incentivize spending on workers, which is odd. Hire more workers to avoid a 2% tax? The US Fed raised their interest rate by 0.75% to 4% on Wednesday. During the press conference, Jay Powell first sounded dovish, implying a slowing in the hikes, and the market went up. And then the speech turned hawkish, implying more hikes, and the market did not like that at all. The US job numbers were also positive on Friday, adding 261,000 jobs for October, 70,000 more than expected. A 50% rate hike in December is expected from the Canadian Central Bank and the US Fed, following the 0.75% hike this week in the US. Some are guessing on pausing in raising to let the raises take effect, is also mentioned for 2023. Others think the top US Fed rate will be 5%, perhaps even 6%. Since we are most of the way through earnings season, it turns out that earnings expectations are being beat 71% of the time as of October 27th, which is lower than the usual 80% or more beats. And that amount being beat by is low to mid-single digits, also less than usual. However, despite the challenge of rising interest rates, tight labor markets, a strong dollar, and slowing nominal GDP growth, companies appear to be doing a good job preserving margins, and earnings are coming in better than feared. With that being the phrase, not as bad as feared, which doesn't mean good. The AI algorithms may be responsible for some of the stock extreme movements. The machines may get the selling started, and then people join in thinking experts are selling, rather than a knee jerk analysis of news releases by the AI without any thought behind it. On Tuesday in the US, stocks turned negative as job openings data for September showed the US labor market remaining tight, and the ISM manufacturing data came in above expectations, causing investors to think that the US central bank will continue to raise interest rates since the economy is still strong. For the rate hikes to slow and stop, the unemployment rates need to increase so demand decreases, and pressure on prices, both in the stores and in the labor market, decreases. On Thursday, the US weekly jobless claims fell to 217,000. Turning to China, the big questions for China remain. How will the country transition to living with COVID? Can the government gradually let the air out of the real estate bubble without huge damage to the economy and the financial system? And in the aftermath of the Chinese Communist Party Congress, will the government attempt to cool both economic and geopolitical tensions with the West? Chinese stocks rallied on Tuesday on unverified reports of zero COVID exit plan targeting March 2023. If China reopens, it will also be a great tailwind for the energy and commodity sectors. Copper and oil are both heavily tied to the Chinese economy and progress, especially the copper. Now let's look at a couple of companies in detail. Looking at Amazon first, just about all of Amazon's pandemic stock price gains are gone. The e-commerce and cloud computing giant suffered its fifth straight losing day in the markets on Tuesday, falling to its lowest point since April 2020. It also fell below 1 trillion in market value. The stock is down nearly 42% so far this year, as the tech titan tries to come to grips with the fact that consumers aren't spending as much money on stuff as they did during the earlier days of the pandemic. Instead, people are fighting inflation by focusing more on essentials, such as groceries, while shaking off more than 2 years of COVID restrictions to eat out, party, and travel more. The shipping giant Maersk on Wednesday warned of gloomy times ahead for global trade, even as it reported record profits stemming from high rates charged by its ocean business. The issues in the economy and the high interest rates weigh on consumers' ability to spend, leading to sober demand for shipping services. In turn, the company believes it has seen a peak in earnings from its ocean business and that things are slowing down in the fourth quarter. Coming back to Canadians' finances haven't been this bad in over a decade. In a Bloomberg poll, 47% of Canadians said their finances have worsened in the past year, and only 13% said their finances improved. In another study from Equifax Canada, the average credit card debt was a record high $2,100, which is the result of people having to spend more with inflation. Retailers overordered their inventories because of supply chain issues and because last year there was a demand snapback. Now they are sitting on very high inventories. Some discounts for Christmas and January to clear the inventory, and lower margins are therefore expected. Companies reporting next week. On Monday, we have Activision and Shaw. Tuesday, we have Intact Financial, Canadian Apartment REIT, Parex Resources, Goeasy, and Magellan Aerospace. Wednesday is Manulife, Rogers Power Corp, Brookfield Renewable, Northland Power, Element Fleet, Vermilion Energy, and Granite REIT. Thursday is a Brookfield Asset Management and TELUS, and Canadian Tire, CAE, and CI Financial. And finally, on Friday, we have Hydro One and Emera. Looking at economic events next week, the big one is on Thursday, where the US has its CPI reading with expected core consumer price index of 6.5%, headline CPI year over year being 8%, and month over month of 0.7%, which are all still quite high. That concludes my thoughts for the week. If you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.